By the way, a sharp downturn in the markets now. We're 180 points lower. So we had a gap down opening slightly, but since then, things have gotten a lot worse. We are 1% lower on the benchmark indices. We've given up all of yesterday's gains. Yesterday, the Nifty had gained 150 points, but as we speak, we've lost 180 points. And right now, in the Nifty 50 basket, there are only 2 stocks holding up in the green. 48 of them are in the red, and that gives you an indication that this is across the board selling that we are seeing. The only 2 stocks which are up in the green are Adani Enterprises, and the other one is Axis Bank, and both of them have a fractional gain going for themselves. The mid-caps are under pressure. The advanced decline ratio too is currently weak. We've got 1,700 stocks currently on the losing side. Just a quick check on the big drags today. Many of the commodity names, as we've been highlighting, Hindalco, Tata Steel, JSW, IT led by Tech Mahindra and HCL Tech are leading the declines. Eicher Motors has given up 2% of its gains. Heavyweights like L&T, Asian Paints, HUL also under pressure. But we've got a new kid on the block, not yet, but there's Ellen Electronics. It opens up for subscription today. It's a 475 crore IPO. To know more about this company, its business model, we're now joined by Vahishta. Vahishta?
Hi, Rima. Good morning. Well, as you mentioned, Electronics is an ESDM company, which is an electronic system design and manufacturing services player for major brands of lighting, for fans, for small and kitchen appliances within India, which includes something like Philips, Panasonic, Havells, Bosch, etc. It serves under both the ODM as well as the OEM business model and is among the largest fractional horsepower motors manufacturers in India with about 10 to 12% of market share. The issue size is 475 crores with a majority coming in from the offer for sale, about 300 crores from there, while the rest is the fresh issue. The issue starts today and ends on the 22nd of December, and the promoter and promoter group holding is currently at approximately 54%, which post-issue would come down to 32.93%. The post-issued implied market cap comes to approximately 1,200 crores, and the proceeds of the fresh issue are expected to be utilized for the repayment of their debt, for funding the capex at the Ghaziabad plant and the Goa plant, and of course the remaining goes for the general corporate expenses. Just a little bit on the peer comparisons. The size of the company is relatively smaller than its peers like Amber and Dixon Technologies, with revenues of approximately 1,100 crores in FY22.
Vaishna, thank you very much for that. To discuss this company, we're now joined by Akash Setia, the head of strategy at Ellen Electronics. Akash, morning. Rima here. This is a highly competitive market, right? Can you tell us about the competitive dynamics? What would be your market share? And if it's competitive, is there a scope for you to increase your margin? And also talk a little bit more about the client concentration risk, because that's been highlighted by a couple of people in the market as a risk for your company.
Sure. Good morning. Thank you for having me on the show. So to your first point on our market share, we operate across 3 key business segments. In the LED lighting segment, we approximately have a 7 to 7.5% market share. In the small appliances business, our market share is approximately 11%. And in the fractional horsepower motor segment, we are market leaders with a market share of approximately 12%. Just in terms of our EBITDA margins, we've historically always been in a 7.5%, 8% kind of band, which are industry-leading margins. The biggest reason for that is the backward integrated nature of our operations. We end up producing most of the sub-assemblies and the components required to manufacture the end product in-house ourselves, which enables us to invariably be amongst the most competitive players in terms of cost, and also enables us to have a higher degree of control over the supply chain and therefore product quality and timelines. Just to your other question on the revenue concentration risk, we worked on bringing that down. We are cognizant of that fact. About 2 years back, probably the top 5 customers contributed to about 75% of revenues. As things stand today, that number is probably down to closer to between 60 and 65%. And our endeavor and focus is to further bring it down over the course of the next few years to close to 50%.
All right. Hi, Akash. Good morning. Akash, I'm reading the money that's going to come to the company will be used for debt repayment and for some capex as well. So 2-part question there. 1, What does the debt come down to post this repayment, or are you going to be repaying everything of it? Point number one. Point number two is, what is the asset turn in your business? Since you're going to be utilizing around 35-40 crores for capex, what is the asset turn? And at peak, with the current investment, with the current gross prop, what kind of revenues can you do? I'm not asking you for a guidance. I'm asking you your capacity. Go ahead.
Sure. So just in terms of your first question on the debt, the total debt on the books of the company is approximately 100 crore rupees. Post the IPO, we expect to be completely debt-free. So that's point number one. Point number two on capex, while we intend to use out of the fresh issue of 175 crores, approximately 40 crores towards capex, it is just pertinent to point out that over the past 3 or 3.5 years, we've already done a fairly large capex of approximately 125 crores. So going forward, we don't expect a material capex to come in. As things stand today, our asset turns are probably, closer to 4x on a gross basis, which, in some sense, the business is at an inflection point where, capex has been done. Revenues will come in the year ahead. On probably a steady state basis, we expect our asset turns on a gross basis to be approximately 5 times.
Akash, just to probe you a little bit, last year you did around 1,100 crores of revenues. As you just took us through, 40 crores plus 125 crores has already been put in. So at
Correct.
peak, what kind of revenues can you do? Keeping in mind that last year you did close to 1,100 crores. What is the revenue potential of the company?
This would be in the range of 1,800 to 2,000 with the completed capex.
Akash, just tell us what sort of your customer base are they exclusive to you? The largest customer for you, is it exclusive, or they work with other players as well in the EMS space? I'm just trying to understand what is the competitive advantage you have, because in this business, if you're a large company, OEM, sort of on the lighting side or whatever, and a company on the other side offers large scale. Your peers are very much larger, right? Amber, Dixon, etc. What's the offering, compelling offering, or the competitive advantage you will have going forward?
Sure. So, the way we view ourselves, like I mentioned at the outset, is that we end up being, philosophically, a customer looks at 3 things in our view, right? Cost, quality, and delivery. Because of the backward integrated nature of our operations for the product segments that we operate in, we typically end up being the lowest cost manufacturers, because as opposed to a mere assembly player, we end up producing most of the components and the sub-assemblies required in-house ourselves. So therefore, we end up, being one of the lowest cost players. Just in terms of quality, because, we are doing everything ourselves, we have a much higher degree of control on the quality of the product, as also on delivery timeline. So, in our mind, if you get the cost, quality, and delivery right, it's a one-stop shop solution for most customers, and therefore it's a winning combination. So, that to our mind is the biggest competitive advantage that we provide our customers. To your question specifically, there is no one-on-one relationship. Customers obviously source from us as well as other players as well.
Just last point, that 1,800 crores that you mentioned, do you have visibility on when you will be able to do that number?
I think, there are SEBI restrictions on talking about, specific timelines. So, I am unable to give you a specific time, but in general, we expect to do that over the course of the next 2 to 3 years. Okay,
all right, Akash, when you list, then we'll have some more questions for you. And at that point of time, you could give us numbers. SEBI as well will, you'll be able to go according to the rules out there. But all the best. And we look forward to chatting up with you on listing date. Well, let's move on then. Deepak Fertilizers, that's the next corporate on our radar. We're speaking to the company post the announcement of a demerger of its mining chemicals as well as fertilizer business to simplify the group structure, and also they believe that they can realize economies of scale. The demerger will take place in the ratio of around 1:1. We have Mr. Sailesh Mehta, the chairman and managing director of the company, who joins in. Hi, Mr. Mehta. Morning. Thanks so much for joining in. Well, you're going ahead and you're trying to unlock some value for shareholders, so we'll have to see how this plays out. But give us a couple of numbers. What is the timeline by which this demerger takes place? I'm guessing you'll have two listed entities. And also, if you could split up for us, what kind of synergy, what kind of, debt breakup could we see in both these two entities?
Sure. Thank you. So first, let me just share that we are in three businesses.
Yeah.
So Deepak Fertilizers into industrial chemicals, fertilizers, and mining chemicals. And now, over the last 40 years, we have developed, a very strong, I would say, base for all the three businesses. And looking at this strong base, we have, thought of now looking at a demerger where each business can be housed in each corporate entity. And this, just to give you a little bit of the rationale, and then I can come to your question, that the whole rationale and the driver behind it is that in each of the businesses, we are planning to bring in a unique, I would say, transformative strategy where we are moving from commodity to specialty or holistic solutions. Or if I would put it differently, from a customer focus, which is the dealer segment, to a consumer focus, which would be going down to either the farmers for the fertilizer business or right down to the mines for the mining business. And so a strong move from, I would say, competitive pricing to value pricing. And in order to somewhere deliver this strategy, the corporate restructuring is something that we have brought in now very strongly. So that right from organization structure, reward recognition, somewhere in terms of even the board focus will be on that business and driving it from commodity to specialty. So that's the undercurrent, I would say, strategy. And the way we look at is from, I would say, if we look at last year's total revenues, the split has been 40-30-30. So almost a similar kind of a split between
Mr. Mehta, Mr. Mehta,
Yes.
some part of what you're saying we already have with us, and you have given out a good press release as well. We want to know more though. So tell us about the timeline by which you believe that these two, you'll have two listed entities. So can you tell us what is the timeline and also how will you break up the debt? I think at peak you were going to have 5,000 crores odd at peak debt levels. So how does it get split between these two entities? Go ahead.
Sure. So basically, in terms of the typical NCLT timelines, it's roughly around 6 to 9 months. And when we are through with that process, the split is going to happen effective from 1/1/2022. So it's a little retrospective. So from that perspective, the split into the three entities will happen effective from 1/1/2022. Now, currently, it is Deepak Fertilizer, where the chemical business is, that is the listed entity. And the other two are going to be the unlisted entity. And we will look at an opportune time for the listing. Currently, what it will do is, of course, help the investors get a much better visibility and somewhere a match between the investors' interest and the corporate entity focus on that business. And of course, it will open up doors for listing, for strategic investors' interests, and so on and so forth. So that is the opening that is emerging out of the demerger. As far as the debt goes, a large debt, project debt, which is for the ammonia project. The ammonia project is going to be housed along with the mining chemicals. And the reason and logic being that, it's a key raw material for the mining sector. So it will give a good, complete value chain into that business. And so in a major sense, the debt portion will be sitting in the mining business, and which is, of course, doing exceedingly well, riding on the very beautiful alignment with the India growth story, whether it's coal mining, whether it's limestone, cement, metals, minerals. So that is a business which is roaring, and that will be where the major debt will be housed.
By major debt, could you tell us the number in the mining business?
Broadly, I would feel that, somewhere close to around 3,500 crores.
Got it. Okay, so one more question. You indicated that for the other two demerged entities, you will look at a listing at an opportune time, and you're also open to strategic investments and partnerships into these companies. Can you tell us in FY24 what is likely? What are the conversations that you're having currently? Do you think a listing is possible in FY24, or it's going to take place a little later?
Probably a little later, because currently the projects are today we have already had completely financial closure for both the ammonia project and the TAN project. So we don't see that need. Conversations with global leaders is continuing, and that is something that's very interesting. So that we will see how it unfolds.
Mr. Mehta, bringing in a partner or a strategic investor, how much will you be looking to dilute in both these two other entities that could be listed at a later date?
So the current, the thought process and the driver behind getting a strategic is what value they bring to the table in terms of technology, in terms of, support, in terms of the customization, the specialty that we are looking at. And based on that, we will see what is the value add that they bring, and then consider, what dilution will make sense and, how it will add value. So currently, it would be speculative to just say that there's a number. We are looking at what is the value add that the strategic will bring to the table.
We could see a strategic investment next year?
You know how it is with the strategic investment. It should make sense, and when it makes sense, we will come back to you.
Is there a particular size that you are looking at before you list the other two entities?
More than size, we are looking at an opportunate time where, the market also sees the value addition. One aspect that is there is that the ammonia project, which is going to be part of the mining business, there we are seeing that by around May, June next year, we will be into production. So that will further, enhance the whole value proposition. So we are seeing that if once some of the capex is all in place, then one could look at the next step and the next step.
All right, and so in the next year, maybe by FY25 or FY24, we'll have 3 listed entities. Is that the plan?
See, the timing of it, like I said, will depend on, the various opportunities.
Ultimately, we'll be looking at 3 listed entities.
Absolutely. So, that is the whole process. The chemicals business, the mining chemicals, and then the fertilizer. So 3 entities.
But in 2 years, that should happen, right? I mean, or whatever you want to do in terms of bringing a strategic investor or the likes, or, bulk of your capex will be done as well. So should we assume by FY25, we'll have 3 listed entities?
You have some good wishes for us. Thank you.
No, the wishes are there, sir, but we want clarity about a timeline. I think what you're trying to indicate is you can't give us a timeline as of now.
Yeah. It's linked to the strategy that we have in place.
Okay, all right. And this, that mall that you have in Pune, which we discussed last time around, which has a potential value of around 650-700 crores odd, is there any progress of divesting that, and which entity will this be housed in?
So currently it is housed in Deepak Fertilizer, which is the listed entity. And we are in the process of somewhere repositioning that business also from a commodity to specialty perspective. And post that, then we will open up the doors for, a variety of restructuring there.
Mr. Mehta, we'll leave it to that. Thank you very much for joining in. That's Deepak Fertilizer and Petrochemicals Corporation talking about their plans when it comes to demerger and the way forward. But let's quickly take stock of the market. Markets continue to slide. Now it's down more than 200 points on the Nifty. The Sensex is lower by 665 points. And this is not the way we started trade, right? The opening was mildly lower. We were down about 0.5% at opening, but now we've slipped more than 1%. The picture across the Asian markets is also worsened. It's the Nikkei, it's the Japanese markets, the Nikkei index, which is leading the losses in the Asian market space. That's down 2.5%. The Taiwanese markets are lower by 1.6%. And across the other markets as well, you are seeing deep cuts. Hang Seng, for instance, is lower by 1.4%. There is a change in the Bank of Japan, policy. It is ultra accommodative, but they are looking to widen the yield curve. Abhilash Narayan, the senior investment strategist group Wealth at Standard Chart, is now with us on the show now. Abhilash, morning. Can you talk about the implications of the Bank of Japan move and why it's rattled Asian markets?
Absolutely. I think if we start with the expectation of the market from Bank of Japan, the expectation was that they would keep the policy fairly accommodative, fairly easy, at least till Q2, Q3 next year. So this effective tightening of policy came as a surprise to the markets, and that's why we are seeing such sharp market reaction. I think the other reason why we've seen equity markets slide down is because Bank of Japan was the last bank which was still holding on to accommodative policy. So with the shift that we've seen in Bank of Japan's stance just now, what it means is that even the most dovish central bank is looking to effectively tighten policy by allowing bond yields to move higher, and that at the margin has hurt the sentiment for the equity markets.
All right, Abhilash, looks like too hawkish to handle. The Fed, the ECB, and now you have the Bank of Japan. But what's the approach to equity markets? For the time being, all the Asian markets are under pressure, and our markets as well. We're down more than 200 points on the Nifty itself. What's the approach? Wait buy, or at some point of time we look to enter into into the equity markets?
Well, it's still a bit too early to say, right? So we've got the press conference from Bank of Japan Governor Kuroda later today in around two hours' time. So we will get a bit more color around that in terms of what is the extent of the shift in thinking from Bank of Japan. But clearly, equity markets could remain under pressure for the next few sessions, given the shift in policy that we have seen. And I think we should not also underestimate the implication of shift in Bank of Japan's policy on the global financial markets, because Japanese yen used to be one of the major funding currencies for a lot of international investors. So that expectation that Bank of Japan will keep rates low and drive the cross-currency trade, that will get reset. We could see Japanese investors who are big international investors withdraw some of the money from international markets and put them back into domestic markets, because the opportunities may start to look a bit more attractive for them domestically. So this the implications of the move will play out over the next few days or even the next couple of weeks. But yes, at the margin, it does add to the whole story that globally central banks are tightening policy.
So the surprise is only in the timing of it, right? I'm sure no one in the market expected Bank of Japan to stay ultra accommodative with a loose monetary policy at a time when the rest of the global markets and central banks have been tightening so much, right? The big surprise is only in the timing. No one thought that it would come in this December policy. As you said, the expectation was that it will perhaps happen in the middle of next year.
Yes, absolutely. So, I mean, we just released our 2023 outlook, and there we had highlighted that, we are likely to see a shift in policy from Bank of Japan. But as you just mentioned, we are expecting that to happen after the term of the current Bank of Japan Governor Kuroda had expired. So yes, the timing is the major shift, but in terms of the direction, it doesn't come as a surprise. But if I look at the implication for, let's say, Japanese yen, we've seen that dollar yen has moved lower by around 2.8%. And what today's move can mean is that we could see dollar yen touch even 130 potentially over the next couple of days. So that could be the big move in currency markets. But yes, it's the timing and the surprise element that is leading to such a sharp market reaction, in our opinion.
All right, Abhilash, final question. You've been saying that this is a bear market rally that we have seen. Is there a possibility we get back, we pull back considerably from these levels, global equities on the whole?
Well, if I look at the outlook for equities, we are still a bit more cautious on the equities over the next 1 to 3 months. And we've recently gone underweight global equities as well. And the key driver for that is we think that the markets are currently underestimating the impact on earnings from the tightening we have seen in global central bank policy. So we think that over the next few months, we could see earnings estimates getting revised down, not only across US and Europe, but also the other major Asian equity markets. And that could lead to a readjustment of investor expectations for 2023. So, we do expect equities to potentially stabilize in second half of next year, but we think that the front loading of those earnings revisions lower could be a headwind for equity markets. So, not looking to add a lot to equity markets right now, but one market where we are a bit more constructive is Asia Japan equity. So we think that the recent shift in Chinese policy in terms of relaxation of COVID-related measures could mean a bit more, a tailwind or a bit more bounce for Chinese equities is still there.
Abhilash, we'll leave it at that. Thank you very much for joining in. The strengthening of the yen also has implications for many of the companies which derive revenues from Japan, like TCS, for instance, has presence in Japan. I'm presuming Maruti as well would have some currency implications apart from the funding implications. We'll slip into a very short break. On the other side, we'll once again invite Mitesh Thakkar. He'll be joining us to give us some technical trades. Welcome back. Mitesh Thakkar is with us and he's going to help us with some technical trades. Mitesh, you were anyway short in the market. What's the stock approach now? You're on mute, Mitesh.
Apologies for that. See, I think the market, yesterday's bounce was slightly an aberration and did catch me off guard, though I think the good thing was that it didn't get past 18,450 levels. I think there's still a more chance of, markets possibly heading towards lower levels. So we're still exploring more of shorting opportunities on stock side. L&T is something which is broken down. That's a sell, and I would keep a stop at about 2170 or just above that over here, and look for a target of around 2100 on the downside. And the other one is ICICI Bank. Disclaimer that we have some put option positions over here. So in that sense, there's a vested interest, but that looks like breaking down as well. So keep a stop at 910, look for targets of around 880 to about 875.
Thank you, Mitesh, for that. Let's now go across to Manisha. She's with us in the studio and she's going to be telling us about the one commodity that she's tracking today.
Well, thank you so much for that, Reema. The markets haven't opened on a very great shake for that matter for commodities, and the gas prices have continued to decline yet another day today. If you look at the last 1 week, we've seen the US natural gas prices decline by nearly 15%, and the TTF, which is the European Union gas prices, those are down by 20% or more in the last 1 week itself. The decline really comes in after the 27 EU energy ministers have agreed to cap the gas prices at 180 euros per megawatt hours there. Well, remember, all of these members are yet to sign, and that is what would be taken in as an accord there. Also, when you look at the gas prices there, this would come in place from 15th of Feb 2023. We've already seen G7 put in a cap on crude prices from 5th of December there. So the next tranche really comes in for gas going forward. As I said, the deal will be formally approved by countries in writing, and that is what the street is awaiting right now. The price cap, as of now, applies to private gas traders outside of energy exchanges. But that's exactly where the concern comes in from as well, because ICE says that if a price cap comes in, then they would move the most traded natural gas contract that they have right now out of Europe. So there's a showdown that you can expect over the weekend when it comes to both of these authorities there. Take a look at the prices then, and we've seen a constant decline onto this one. This actually is the IEA report which says that 30 billion cubic feet of a shortfall is what you can expect in sense of gas in 2023. That clearly has been moving the prices as we've seen them. The other thing is the gas demand itself, which is expected in Europe to be at 395 billion cubic meters there. This is what the gas prices have done in this year. This is a report card really. When you look at the US gas prices, we've seen a high of nearly $10 per MMBTU and a low of 3.5. Currently, we're trading at 5.8. Even bigger range is what we've seen in the European markets at a tune of nearly 350% of a move that we've seen in this year. This is the seasonality in price. This is quite interesting, really, because when we talk about natural gas, we expect the gas prices to be firm during the winter months. That's exactly what they do not do. This is a report from Capital.com, and this is an analysis that they have put across from 1991 onwards. It suggests that in the winter months like Jan, Feb, etc., you actually have seen the gas prices weaker because this is the time that countries store enough gas and they're watching out for the winter demand. It usually also is weaker when you look at the summer months, which is June, July, August, etc. The prices start to build up from August, September, October onwards. Those months should come in on your screens, and those are the most bullish months, by the way, because this is between the winter demand and the summer demand, and this is the time when you already are building up for the winter demand expectation. So this is the time where the demand is at the highest, restocking is happening. So September, October is actually the highest moving months in that matter. The final plate comes in, and this is the gas price outlook. And while we've seen $10 per MMBTU of a high price in this year, that is not the expectation that the banks and brokerages have for the next year. Most of them are talking anywhere between $5 to $8, $4.5 to $4 exactly is what Bank of America, UBS, and Citi also seem to be talking about.
Manisha, very interesting. Thank you very much for that. Get into a break. On the other side, our special segment, Outlook 2023. Lata will get chatting with Samiran Chakraborty of Citi Research and Surendra Goyal of Citi to discuss their India outlook for next year. Stay tuned.